Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here. And honestly, looking at the research we've got today, we have quite the puzzle on our hands.
We really do. So I was just checking the calendar and it's early February 2026. And if you just look at the financial world right now, it feels totally upside down. Like we're living in a tale of two extremes, isn't it?
That's a really good way to put it. It's not just that things are weird, it's that the time horizons have completely fractured.
Yeah.
We're seeing two completely different games being played at the same time.
Right. So on one side, you have these huge global corporations, the backbone of the economy, and they're going completely silent about their biggest, most expensive long-term projects.
Planning for a decade out, spending billions, but
Yeah.
just refusing to talk about it. It's like a secret club.
Exactly. And then on the complete other side of the spectrum, you have the stock market itself. And it's turned into this high-speed, adrenaline-fueled machine where traders are betting billions of dollars on what's going to happen in the next 5 minutes. It's such a contradiction. We've got this thing called green hushing, this strategic, almost paranoid silence.
And then the explosion of zero DTE, 0 days to expiration options.
Okay, I know this sounds like jargon, finance speak, but our goal today is to break this all down into plain English. I want to get this without needing an economics degree.
Absolutely. The mission today is to really look under the hood at the machinery. And we're not just guessing here. According to the data we're looking at, all this is based on a stack of analysis, recent news reports, and market studies that show exactly where the money is flowing.
Right. We're not using a crystal ball. We're following the numbers. So let's start with the quiet ones. This. Green hushing.
Let's do it.
Okay, so green hushing. It sounds like something you do in a library, but from the reports, it's way more serious. What exactly is it?
So imagine you have a friend who is secretly on a diet. They're eating healthy, they're working out, doing all the right things. But then they go to, say, a Super Bowl party.
Okay, I can picture that. Wings, nachos, a total dietary minefield.
Exactly. And your friend grabs a big salad. But instead of saying, oh, I'm trying to eat healthy, which invites all sorts of questions and maybe judgment, they just say,
I just really love the crunch of this lettuce right now.
precisely. They're doing the healthy thing, but they refuse to label it healthy because they don't want to have the conversation about it.
Okay, I get it. So that's green hushing. Corporations are still pouring billions into green energy, solar, batteries, all of it. But they are terrified to talk about it.
They're doing the work, but hiding the label.
But why? I mean, for years, every company loved to shout about how green they were. Every annual report had a wind turbine on the cover. Why go quiet now?
According to the analysis, the answer is, well, it's politics. The political atmosphere here in the U.S. has become, and this is a quote from the reports, toxic.
Toxic. Wow, that's a strong word for a financial analysis.
Yes, it is, but it fits. I mean, we're in 2026, President Trump is in office, and the anti-ESG movement has really kicked up steam.
And just so we're all on the same page, ESG is environmental, social, and governance, right?
Right. It's a framework for investing. And for a while, having a high ESG score was a good thing. It attracted investors. But now, recent analysis shows that companies genuinely fear political wrath if they're too loud about climate goals. It's gone from being an asset to a liability.
So if a CEO says we're going net zero, they're not getting applause. They're basically painting a target on their back.
That's it, exactly. And it's not just about angry tweets. It's about real financial risk. I mean, look at what happened with that Texas law, SB 13.
Oh, right, I remember that. It was aimed at banks that were seen as anti-fossil fuel, wasn't it?
It was. It basically said if you boycott fossil fuels, you can't manage our state pension funds. Now, that law was just ruled unconstitutional. The court said, you can't punish companies for their point of view.
So the law got struck down. Shouldn't that make companies feel safer then, if they won in court?
You'd think so, but the data suggests the damage was done. The lesson companies learned wasn't, hey, we can win in court. It was, wow, politics can really, really mess up our business. They realized being vocal about ESG just brings lawsuits and headaches.
I see. So even if you win the fight, you still end up with a black eye and a huge legal bill. It's smarter just to shut up.
It's pure risk management. Silence is safe.
Okay, but here's the part that really gets me. If they aren't talking about it, does that mean they stopped doing it? Did all the solar panel projects just get canceled?
And that's the big twist. If you look at the reports on capital expenditure, where companies are actually spending their cash, the spending hasn't stopped at all. In some sectors, it's actually accelerating.
Wait, really? So they're scared of the politics, but they're building the stuff anyway. Why?
Because it's not about morality anymore. It's not about doing the right thing or saving polar bears. It's about cold, hard cash. It's about the bottom line.
Okay, break that down for me. How does buying a solar farm make you money if you can't even use it in your marketing?
The data's pretty clear on this. Renewables and battery storage have crossed a huge threshold. They are now just essential, cost-effective infrastructure. If you run a giant factory or an AI data center, you need power that is both cheap and predictable.
So it's like buying a generator. You don't buy a generator to make a political statement. You buy it because you want to control your electric bill.
Exactly. It's a cost-cutting measure, not a political statement. Look at a real-world example from the data. Total Energies and Airbus.
The airplane company.
Yep. They signed this massive 10-year deal for power. A few years ago, the press release would have been, a green alliance for a sustainable future.
Right, with pictures of leaves on it.
But not anymore. Recent reports show it's being sold as price stability. Airbus is just hedging against volatile energy prices. They know exactly what their power bill will be in 2030. That is just smart business.
That makes perfect sense. If you rely on natural gas and some war breaks out, your costs could triple overnight. The sun doesn't charge you more because of geopolitics.
Precisely. It turns a variable cost into a fixed cost. We're seeing the same pattern with Ørsted, the big wind power developer. They sold off some European assets, and the headlines might look like a retreat.
Wind giant scales back.
Yeah, I can see that.
But the financials show it's just smart capital allocation. They're moving money from places with tricky regulations to places where they can get a better return. They're chasing profit, not applause.
So shareholders aren't asking for climate slogans anymore?
No, they're asking for profit proof. Show me how this wind farm makes us richer. If it does, great, build it. Just spare us the lecture.
So the takeaway for all of us is what?
You have to be a detective. Don't listen to what companies say or don't say. Look at their contracts, look at their spending. The green revolution is still happening. It's just gone undercover as operational efficiency.
The revolution has gone undercover. I love that. Okay, so that's the slow, quiet, long-term game. Now, I want to flip to the complete opposite.
The loud part.
The very, very loud part. While CEOs are playing chess, the stock market floor has turned into a high-speed betting parlor. We have to talk about zero-DTE.
0 days to expiration.
0 days to expiration. Even the name gives me anxiety. Can you explain what this is for someone who, just has a 401k and isn't a day trader?
Of course. Let's use a sports analogy. So traditional investing is like betting on who's going to win the Super Bowl at the very start of the season. You're looking at the big picture, and you wait a long time to see the result.
Okay, I'm with you. I put my money down and I wait 6 months.
Right. Now, 0-DTE is like being at a baseball game. And instead of betting on the winner, you're betting on the very next pitch. Will it be a strike or a ball? And your bet expires in 10 seconds.
Wow. Okay, so it's instant gratification.
It's an instant loss.
Yeah.
You're not investing in a company's future. You are betting on its stock price movement in the next, 5 minutes. And is this just a small niche thing?
Not at all. The scale is. It's just staggering. According to the data, about 60% of all the options volume on the S&P 500 is now 0-DTE.
60%.
More than half. The majority of the action. This means the market isn't just moving based on news anymore. It's moving based on what we call market plumbing. The hedging flows from all these tiny short-term bets.
Market plumbing. Okay, how does that affect someone like me with a 401k? How does someone's one-day bet move the whole market? Isn't it just a side bet?
That's the thing. In a stock market today, the bet actually makes the horse run faster. It's this tail wagging the dog situation.
How does that work?
So let's say traders buy millions of these options on, say, NVIDIA. The data points to days where there are over 3 million contracts traded on a single Monday.
That is an insane number of bets.
It is. Now, for every bet, there's a dealer, usually a big bank, on the other side. They sold you the option. So if you bet the stock goes up and you win, they lose. So they have to protect themselves. They have to hedge.
Okay, so if I bet the stock goes up, the bank is at risk. So to cover that risk, what do?
They go out and buy the actual stock. So if you buy a call option, the dealer has to buy some of the underlying stock to cover their potential loss to you.
But wait a minute. If the dealer buys the stock, that pushes the price up.
Correct. And if the price goes up, maybe more people buy call options, forcing the dealer to buy even more stock. It creates a feedback loop, this artificial volatility. A stock can shoot up or crash in minutes, not because of news, but because of this hedging machine.
That sounds really dangerous. What happens if everyone bets the wrong way at once?
That's the tail risk everyone's worried about. If a real crisis hits and everyone runs for the exits at the same time, this hedging can act like gasoline on a fire.
So instead of buying to stabilize things, the dealers would be forced to sell.
Exactly. If everyone buys put options, betting the market goes down, the dealers have to sell stock to hedge. And that selling pushes the market down even more, which forces more selling. It can accelerate a crash very, very quickly.
You know, this whole thing reminds me of those prediction markets I've been seeing, where you bet yes or no on things.
It's a very similar mindset.
Mhm.
And you're right, those are sort of a gateway to this kind of thinking. It's training people to see the market as a casino for entertainment, not a place for long-term saving.
So if I'm a listener and I look at my phone at 2 o'clock on a Tuesday, and the market is just going completely haywire for no reason,
It might just be the zero-DTE crowd. It's the plumbing rattling.
and the advice is, what? Don't panic, sell.
Absolutely do not panic sell.
Mm.
For the long-term learner, you have to ignore the minute-by-minute noise. The market is just structurally more volatile now, but that doesn't change the fundamental value of the companies you own for the next 10 years.
Don't panic just because the plumbing is loud. I like that. So let's connect all this.
Let's do it.
On one hand, you have green hushing, corporations being secretive to avoid political drama. On the other, you have zero DTE, traders being loud and fast, turning the market into a casino.
And when you zoom out, you realize both trends are really about adaptation.
Adaptation. How?
Well, companies are adapting to political risk by going quiet. Traders are adapting to new technology by speeding up. The environment changed, so the behavior changed.
So everyone is just playing by the new rules of the game.
Exactly. But notice the split. The corporations are thinking in decades, locking in 10-year contracts. The market is thinking in minutes.
Which means the most important skill for us is looking under the hood, right?
Mm.
Look at where companies are spending their money, not their slogans. And look at the long-term trend of your portfolio, not the daily chaos from the gamblers.
That is the perfect summary.
Thank you so much for breaking all this down. It really puts things into perspective.
My pleasure. It's always fun to dig into the data.
And a big thank you to everyone listening. We hope this deep dive helps you make sense of these wild markets. Don't forget to subscribe and hit that like button.